Hello, class, and welcome to week 2 of BACC 531 Managerial Accounting. This week, we're going to connect three critical pieces of what's known as a job order costing system. First, we'll calculate unit product costs and learn how to do that with accuracy and how to bring those components together. Secondly, we'll learn how costs flow through the accounting system. And thirdly, we'll learn together how those costs ultimately appear in financial statements. This topic is foundational not just for accounting, but for managerial decision making, pricing, and profitability analysis, as we'll see together. We'll move ultimately from mechanics to the system itself, and then ultimately to the reporting implications of job order systems and costing structures. So, as we dive in, let's begin with the big picture when it comes to job order costing systems. A job order costing system is used when companies produce customized or distinct products or services. Some examples of this could include situations like aircraft manufacturing, construction projects, consulting engagements, or other types of business contexts where the end product or service is something that is unique to the individual customer who's placing the order. If you're thinking about certain service situations, aside from consulting, which is a major area of service activity where job order systems become appropriate, healthcare often consists of situations where job order costing can be helpful. When you think about surgeries or you think about complex medical procedures, oftentimes we think of that as a sort of one size fits all. You're having a hip replacement or a knee replacement or a heart valve replacement. But for those of you that either work in a medical profession and have some familiarity and connection with that, or for those of you that may have yourself or had a loved one who've experienced that, you know that there's also a unique dimension to each of those. No two patients, no two people are the same, and thus the specific set of materials and requirements, and in some cases, even the specific procedures, can have a degree of variance between one situation and another. Thus, there's a whole host of different business situations and contexts where job order systems can become appropriate. The key is in a business situation where job order costing is an appropriate methodology, each job that's being provided or produced is going to be unique, and so we will track those costs individually. There are three key product cost components when it comes to not only job order costing, but really any manufacturing or cost tracking system. Number one, direct materials. Number two, direct labor. And number three, manufacturing overhead. Direct materials and direct labor are called direct, that adjective descriptor that leads off in their title, because they can be traced directly to jobs in question. They're easy to trace without violating the cost benefit constraint, and they also are often called prime costs. They are primary costs that are directly traceable to the product or service. If I know that it takes exactly 5 pounds of material to make some product, if I know that it takes exactly 5 gallons of some other material to make some product, I can trace that material in whatever form it comes directly to each individual unit with relative ease. Thus, it is a direct material. In contrast, there are other types of materials, such as grease or lubrication from machines that are doing manufacturing, that we know are going to be gradually consumed through the manufacturing process, but they cannot be directly traced on a unit by unit basis with the same degree of ease. I know that in theory they can be traced, and some of you may work in a background where you have done projects where you've traced those types of indirect materials. What we are saying here is that we cannot trace them with ease without violating the cost benefit constraint. We're not saying it's theoretically impossible to directly trace indirect materials, but the cost of doing that would not justify the benefits in most settings, in most business applications. And thus, those types of costs that are indirect, that cannot be directly traced to end products or services, are what we classify in a third category called manufacturing overhead. So, manufacturing overhead includes those indirect costs such as factory rent, utilities, and indirect labor that cannot be directly traced with the same ease or the same convenience and the same low costs of doing that tracing. Thus, they're going to be allocated using a predetermined overhead rate instead of being directly traced on a unit by unit basis. The rate that we will use, the basis for that allocation for those indirect manufacturing overhead costs, is what we will call the predetermined overhead rate. The predetermined overhead rate is calculated by taking the estimated total manufacturing overhead for the period in question. Typically, that's going to be a year or an annual period of time. That goes in the numerator of the calculation. In the denominator, we will take some estimated allocation base. That base can vary from one context to another. In some cases, it may be machine hours. In some cases, it may be total estimated annual direct labor hours. There's different ways and different bases that we'll explore that can be used in that calculation. But in whatever context and whatever situation we're doing it, the predetermined overhead rate is always going to be some estimated total amount of overhead, an estimate, a prediction for the year, divided by some estimated allocation base in terms of units. Thus, what we get on the outset, what we get as a consequence of that, is a certain dollar amount of overhead to be allocated per unit of whatever that base is. This allows managers in practice to estimate costs in terms of overhead before the period ends, which is essential for pricing and planning decisions. Once we have the predetermined overhead rate, we then can apply overhead to jobs using a simple calculation of that predetermined overhead rate, that dollar amount per unit of whatever the driver activity is, multiplied by the actual activity amount. So if I'm calculating a predetermined overhead rate for the year on the basis of machine hours, if I've got that calculation, so many dollars in terms of overhead per machine hour, to do the application, I would simply take that period's actual machine hours. So let's say it's for the month, in this case, of May. If I am trying to calculate my overhead and I know I have 5,000 machine hours incurred during this month or during this period for this particular product line or setting or production area, I simply take the total amount of machine hours and multiply it by that rate. That gives me the amount of overhead to be applied for that particular business context, whether it's the entire company, whether it's an individual division, whether it's an individual manufacturing plant. I can apply that using that estimated rate on a period by period basis. This process is part of what we call normal costing, where direct materials and labor are actual, but overhead is applied using estimates. The reason for that is, I'll just say, multifaceted, but the best way to summarize it is to think of how overhead, those indirect costs, behave. In most manufacturing settings, overhead and the types of items, those indirect costs, indirect materials and labor that flow into that, are not necessarily consumed on an even or an expected basis. The ability to estimate that using that rate prevents cost distortions. Oftentimes, those indirect materials may be bought in bulk up front, but consumed on an uneven basis throughout the year. Using an estimated rate enables us to have a more stable calculation of product cost and ultimately one that will generally turn out to be more accurate without having to assume that we've got an enormous cost for indirect materials in one period and then no cost in the following period because they were purchased in bulk or because they were consumed on a different or a relatively uneven basis. Thus, the use of that estimated rate enables us to prevent certain types of cost distortions in practice and gives us the benefit of what will ultimately turn out to be a more accurate costing approach. All of this information, direct materials, direct labor, and manufacturing overhead applied during the period, is going to be captured in a source document or a source data sheet, a database in many cases, or a table that is, that we will refer to as the job cost sheet. Historically, this was an actual piece of paper that tracked the total materials, labor, and overhead costs for an individual job. Nowadays, that's typically in some type of digitized form within an accounting information system. But what this job cost sheet, in whatever form it comes, will serve as is the central record in terms of financial information for each individual job. It accumulates direct materials, direct labor, and applied overhead, and at the end of the production process for that job, whatever that job is, it will provide a total job cost. And if there's more than one unit being produced, it will also provide a unit cost. If you're thinking, well, wait a minute, I thought you said, Dr. Broth, that this is all on an individual job by job basis. As each individual order is placed, we track this separately. That's true, but remember that an individual order or an individual job that's committed unto us by a customer can sometimes consist of multiple units. For example, you might place an order with a custom furniture manufacturer for multiple pieces of furniture. Well, your individual order is going to be an individual job, and then there may be multiple articles of furniture produced with that. You may buy a couch, you may buy a sofa, you may buy a love seat or an ottoman and a table to go with that. The fact is, depending on how that manufacturing process or how that manufacturing company is set up, there's different ways that that can be traced and allocated. But in the event that an individual job consists of more than one unit, this job cost sheet will enable us to calculate a unit cost as well. These figures are critical for pricing, profitability analysis, and performance evaluation in practice. When it comes to the flow of costs through accounts, we need to examine the basic process or the tracing of measurement of inventory in a job order costing system. There are three key inventory accounts that we're going to look at. They include raw materials, work in process, often abbreviated as WIP or WIP, and then finished goods. The flow works as follows. When raw materials are purchased, think of that as the raw or the basic ingredients in manufacturing or providing certain types of services. These are going to be classified into the real creatively entitled account, raw materials. Raw materials are placed in the raw materials account. Once those materials are issued to production, meaning that some of those are taken from storage and actually placed into the production process, direct material is classified in that second inventory account called WIP or work in process. Remember, as we talked about during week one, we are not creative namers in accounting. That is by design. We're pragmatic. And so if you think about the name, will help remind you of the stage of inventory or the stage of production we're dealing with. Raw materials means no manufacturing has yet begun. Work in process means it isn't finished, but it is actually in process. It's undergoing that transformational change that we refer to as manufacturing, or in a service context, the providing of the service in question. Finished goods, as the name implies, means that the goods in question are indeed finished. Manufacturing is now complete, and thus, as we trace it through that system, it will follow that basic model. Direct materials will go into work in process, so also will direct labor flow into work in process. Indirect materials and indirect labor do not flow directly into work in process. Instead, the actual costs incurred for those will be classified within manufacturing overhead. And again, we're going to allocate that period over period using that predetermined overhead rate. Actual overhead costs are accumulated and tracked separately. Overhead is going to be applied to work in process using that predetermined overhead rate we just talked about. So at this point, work in process will consist of direct material, direct labor, and applied overhead that's been calculated during the period. When a job is complete, costs will move from WIP or work in process to finished goods. And then, once the job is sold, that value will leave finished goods inventory and then move to an account called cost of goods sold. Not only is it transitioning in that case from one account to another, once it moves from finished goods to cost of goods sold, it ceases to be reported on the balance sheet as an inventory, a current asset item, and instead becomes an expense, something that offsets revenues on the income statement. If you're trying to remember that or to remember that last step of transitioning to cost of goods sold, remember the basic purpose of inventory. As I often teach my undergraduate accounting students and majors when introducing them to these basic concepts, we don't acquire inventory simply to admire it or to have it for personal enjoyment or to hug it, squeeze it, and call it George, as the saying goes. We acquire it even though we may like our products, we may enjoy what it is that we're doing or making or selling. That's a wonderful thing. But inventory is always held in some form for resale. If it's not held for resale, it's not really inventory. Inventory can have a long operating cycle, meaning we may hold it even a series of years before we actually end up selling it. But fundamentally, inventory exists in business to be sold for the generation of profit. Thus, the ultimate goal is not for this item that's being manufactured to wind up and finish its life in finished goods. That simply just means manufacturing is complete. The end goal is for it to wind up in cost of goods sold, meaning it's actually been sold to the customer and now it's hit the income statement to offset the sales revenue that's been produced by it. When it comes to the financial statement impact that flows out of that as a consequence, there are two key documents that relate to the financial statements, two key schedules that will summarize these cost flows. There's first the schedule of cost of goods manufactured, which summarizes total manufacturing costs, adjusts for beginning and ending work in process, and produces as a result the cost of goods manufactured for the period. Secondly, there's also the schedule of cost of goods sold. This begins with finished goods inventory, adds cost of goods manufactured, subtracts ending finished goods, and then produces as a consequence the cost of goods sold for the period in question. These schedules that you'll explore this week link the balance sheet and the income statement together for purposes of analysis and management. Product costs flow through inventory accounts, while period costs, such as selling and administrative expenses, remember, are expensed immediately and hit the income statement in the period in which they're incurred. Let's return to overhead for just a moment. Because overhead is applied using estimates, applied overhead rarely is going to end up being equal to the actual overhead amount in any given accounting period. This creates a situation where we have a bit of an imbalance. We may have underapplied overhead, which occurs when the applied amount is less than the actual, or we may have over applied overhead in which the applied amount is greater than the actual. Remember, once again, we're not creative namers here. Under applied means we applied too little. Over applied means through that predetermined overhead rate, we applied too much. That dollar amount of difference, the variance between the estimated amount that ended up in work in process and the actual amount incurred at periodic intervals, has to be adjusted. There's two basic approaches to doing that adjustment. The first, the simplest, is to write off the entire amount of the variance to cost of goods sold, either raising it or lowering its balance, depending on whether we are over or under applied in terms of overhead. In the event that the dollar amount of variance, that over or under applied amount, is relatively small, what accountants would call immaterial, not big enough to make a meaningful difference in decisions, then we can simply lump sum it to cost of goods sold, and that's fine. In the event the dollar amount is material, meaning it's a relatively large amount or it's big enough to make a difference, it is best not to write that off to cost of goods sold. Instead, we should use a weighted average approach and allocate it between work in process, finished goods, and cost of goods sold. If you're thinking back to our basic inventory accounts, you may wonder, well, wait a minute, Dr. Brock, what about raw materials? I thought we had that as an inventory account too. We do, but remember, raw materials is the state of the basic raw ingredients before any manufacturing. That is the application of direct labor and overhead, our conversion costs, has occurred. Thus, when it comes to some variance between the actual and the applied amounts of overhead, it wouldn't make sense to allocate any of that to raw materials because no overhead should have been incurred when it comes to raw materials. We only start incurring overhead once manufacturing begins. So that means we start with WIP and then we'll allocate some to WIP, some to finished goods, and some ultimately to cost of goods sold. When it comes to job order costing, just wrapping things up in summary here, job order costing is critical for decision making in these customized business contexts. Inaccurate cost assignment through bad costing approaches can lead to incorrect pricing decisions, misleading profitability analysis, and also ultimately poor strategic decisions. Improving accuracy in practice involves first selecting appropriate allocation bases, and secondly, using multiple overhead rates or activity based costing in order to improve accuracy. Tools in practice like Microsoft Excel can help model cost flows and connect them with financial statements. And added to Excel, there's a number of other technologies, a number of other data analytics tools that we can further integrate to enhance our analysis. You will begin to explore those this week as well. In summary, job costs we recognize are accumulated using direct materials, direct labor, and applied overhead, those basic categories. Costs will then flow through inventory accounts, including raw materials, work in process, and finished goods. These costs will ultimately determine cost of goods manufactured and cost of goods sold. And remember that overhead estimation differences impact profitability. They do make an impact, and thus we have to manage, analyze, and understand them accurately in order to understand and to manage the nature of how we're operating and what those impacts are going to be. With that, I want to thank you for watching this overview of our concepts in job order systems this week. As always, if you have any questions, please reach out. You can reach me by email at jake.brock@ucumberlands.edu. I'll be glad to hear from you and glad to help you with any questions that you have. With that, thanks for watching and have a fantastic week ahead.